Bloomberg Audio Studios. Podcasts, radio, news.
The Federal Reserve voted to cut interest rates by 25 basis points. That's a quarter percentage point after holding them steady this year. This is a pretty boring outcome for a meeting that's had a lot of drama around it. By boring, I mean well telegraphed, expected, no surprises, just how the Fed likes to operate. Here's how Fed Chair Jerome Powell explained the decision to reduce rates.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet.
The drama around this meeting was more about politics than monetary policy. President Trump has been pressuring policymakers to lower interest rates. On Sunday, he called for a big cut.
I think you have a big cut because I don't think he can help but cutting. It's perfect for cutting.
And Trump has been trying to reshape the Federal Reserve to make it more responsive to his wishes. In fact, the Fed meeting started on Tuesday, but it wasn't until Monday that we knew who would actually vote on the committee. That's when the U.S. Senate confirmed the president's pick to fill a vacancy on the Fed's board, one of his chief economic advisors, Stephen Miron. It's also when a federal appeals court ruled that Fed Governor Lisa Cook, who President Trump has tried to fire, could hold on to her seat, at least for now. So this boring rate cut, it shows the Fed seems to be resisting political meddling, for now. Amara Omeokwe covers the Fed for Bloomberg, and she says it also signals growing unease about U.S. employment.
So there's just growing concern among some Fed officials and economists that the labor market could be at a tipping point. And the problem with that is once the labor market weakens, once we really start to have unemployment rise, it can happen very quickly and severely.
There was a very lackluster jobs report for the month of August and a big revision of jobs data for a 12-month period that ended in March. That report showed the U.S. economy added about 911,000 fewer jobs than first estimated. But the Fed also has to keep an eye on inflation. And Amara says that means the Fed needs to strike a delicate balance.
There are concerns about the potential for tariffs to drive inflationary pressures in a way that is persistent. And so that is part of the Fed's challenge right now.
Powell acknowledged this tension in his post-meeting news conference.
Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation.
I'm David Gura, and this is The Big Take from Bloomberg News. Today on the show, what the Federal Reserve's rate cut says about the state of the U.S. jobs market, the broader economy, and the central bank's independence. The Federal Reserve's interest rate cut of 25 basis points was very much in line with what Wall Street's expected. I asked Bloomberg Fed reporter Amara Omeokwe what a quarter-point cut tells us about how the Fed is thinking about the economy.
What it signals is that concerns about the labor market have grown, and the Fed wants to respond to that. At the same time, there was some talk about whether they should do a bigger cut, a half-point cut. And by them not doing that, I think that is also an acknowledgement that there are still concerns about the inflation responsibility that they have. And they don't want to go too fast or too big, right? So they really are trying to balance concern for the labor market and concern for inflation.
This is what's known as the Fed's dual mandate. Its two main goals are to keep inflation in check and to promote maximum employment.
Sometimes the goals kind of align where they can kind of address both at the same time, right? So last September, they did a half-point cut. And they did that because there were warning signs in the labor market at that point. But at the same time, inflation was kind of moving in the direction that they wanted it to move. So they could lower rates in a way that they felt comfortable with because they weren't necessarily worried about inflation. The problem here is that we're kind of in the opposite scenario where there are growing concerns about the labor market. And at the same time, there are concerns about the potential for tariffs to drive inflationary pressures in a way that is persistent. And so that is part of the Fed's challenge right now. Their mandates are kind of in tension, And unlike last year when they were like, well, labor market is a little iffy, inflation is moving in the right way, so we can make this very clear-cut decision. Here, it is not as clear-cut of a decision. That is why they have been on hold all year. And that is why we are seeing among Fed officials themselves growing disagreement about what the Fed should actually be doing right now.
Not all the Fed governors were on board with this decision. Notably, the newest member of the committee, Stephen Miron, who's been the chair of President Trump's Council of Economic Advisors, dissented. I asked Amara about the argument both Miron and the president have been making for going bigger, for cutting rates by a 0.5 percentage point, as Miron advocated for at this meeting, or more.
So I think people who were talking about a big cut, there are a couple of reasons, right? If you are in the camp that, okay, the Fed has been on hold this whole year and they were wrong to be on hold, then you say, look, they need to kind of fix that by going bigger here, right? Kind of making up for lost time or making up for lost ground. So they need to go bigger here. The president's argument is a little different. He is calling for very large moves because he has a couple of different economic policy goals that he essentially wants the Fed to support. Namely, he wants borrowing costs for the U.S. government to come down. And he feels that by the Fed cutting more aggressively, that will help him in this effort that he has to bring down the government's borrowing costs, shrink the deficit. And so the president, I think, is speaking more in favor of his own economic agenda, whereas those who are concerned that maybe the Fed's policy is having too much of a restraint on the economy right now, especially as we have these growing labor market concerns, have said perhaps it makes sense for the Fed to do a bigger move to kind of take some of that restraint off.
You look at Fed Chair Jay Powell's tenure, and for so long he was so good at fostering unanimity among members of the Fed's rate-setting committee. That started to change at recent meetings. We've seen more dissents. We're seeing members of this committee take different positions. Ahead of this meeting, there was some uncertainty about who'd actually be there. Lisa Cook, a Fed governor, was allowed to sit for this meeting. An appeals court ruled that she could participate. The president wants to fire her from the committee. There was a new committee member, Stephen Miron, a Trump economic advisor, who was confirmed by the Senate on Monday, really at the 11th hour here, just in time for the start of this meeting. How much has Fed Chair Jerome Powell's job changed, kind of managing all of these different perspectives now that we're here in September of 2025?
Yeah, I think he has a much harder time right now, right? Because let's compare where we are now to where we were when inflation took off in the wake of the pandemic. Then policy decisions weren't that hard, right? Inflation is at multi-decade high. What should the Fed be doing? In that situation, it should be hiking. It should be tightening, right? And so there was a little disagreement, but not to the extent that we are seeing now, right? Because the economic outlook is just so uncertain. And there are a range of views about, just how weak the labor market is, what factors are driving the weak labor market data that we've seen, what the impact of tariffs will be, right? So there's just so much more uncertainty now that just makes it harder to have consensus. At the same time, this growing lack of consensus, I think, is just like such a poignant representation of the fact that change at the Fed is at hand. It is happening. These changes with Stephen Miron joining the board, President Trump trying to oust Lisa Cook, like this is just the beginning, right? President Trump is going to pick a new chair. And that chair is likely going to be very different from Chair Powell. And so all these changes, the dissents, the new people leaving, President Trump trying to fire people, it's just the clearest sign that this time next year, we're probably going to be looking at a very different Fed than what we have now.
Coming up, inflation, employment, and revisions. What Fed policymakers see when they dig into the data. In setting interest rates, the Federal Reserve is famously data dependent. That's their way of saying there's no gut feelings, no vibes. They stick to the numbers. Fed policymakers look at all kinds of data, but they pay extra close attention to employment and inflation. Bloomberg's Amara Omeokwe says inflation is still higher than they'd like.
So inflation is still above the Fed's 2% target. And the impacts of President Trump's tariffs, the policies have obviously changed a lot since, he first announced them, have started to show up. But the feeling is that the inflation data is suggesting that for now, companies appear to be absorbing most of the costs of these tariffs and not passing them on to consumers. And so people who are in support of rate cuts are taking the inflation data and saying, see, tariffs aren't really showing up in any kind of meaningful way so far. Therefore, the Fed can cut. Therefore, they don't need to be on hyper guard about tariff-induced inflation. But then you've had Chair Powell and others say, look, it is possible that, these tariffs will result in a inflation bump that quickly passes, but we can't take that for granted, especially with the fact that inflation is not yet back at our target. So we have to be a little careful. So that's where we are.
Powell addressed that challenge at his press conference on Wednesday.
Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed.
Let's shift from that side of the dual mandate, the inflation side, to the employment side. How healthy is this labor market today? What are the things that are raising the concern of policymakers?
So the labor market is really tricky right now, right? Because it is very clear that demand from employers for workers has slowed. At the same time, though, the Trump administration has implemented stricter immigration policies, stricter immigration enforcement. And so that is also, economists think, weighing on the supply of labor. So you have both labor demand and labor supply falling at the same time. And so that kind of obscures the picture, right? Chair Powell has called this a curious kind of balance.
Here's what Powell said about that on Wednesday.
Typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Because both of these things are happening in tandem, it's kind of hard to know, is the labor market really weak? Or are we having a demand issue? Are we having a supply issue? What is really happening? So we have seen the pace of job creation really slow in the final months of the summer. And we also got revisions that suggested that the amount of job creation in 2024 and early 2025 was much weaker than originally estimated. So the numbers don't look great, but it's kind of hard, given all the policy changes that we've had, for policymakers to figure out, okay, what is actually the root cause of this weakening that we're seeing? And so that's what's making it a little tricky here.
You mentioned those revisions, and the numbers seem huge. I know that it's common for these numbers to be revised, but it strikes me this has to compound the difficulty for the Fed. They're relying on jobs numbers that are inherently backward-looking. And then you have these giant revisions. Could you talk a bit more about that, how what we're seeing, or what we have seen in recent weeks, is normal or isn't?
I think what you said is exactly right. So you talk to any economist, they're revisions, they happen all the time. These annual revisions happen annually, right? They happen all the time. I think the magnitude of the revisions is what is giving people a little heartburn, right? And it's interesting, Lisa Cook talked about how when you are seeing large revisions like this, it usually is because the economy is at an inflection point and things are changing in a way that you have to pay attention to. And so I think it does make the Fed's job really tricky because the data is changing. And because so much of their calculation this year about holding rates steady was because they felt like the labor market was giving them almost the luxury to do so, right? We are scared about tariff inflation, but we have a good labor market, so we can afford to keep interest rates a little high here. But now that narrative is really being challenged by the recent reports and the revisions. And so it kind of, in a way, compels them to move, but then they're still dealing with the inflation question. So it's all very tricky. Also to mention that President Trump has sort of zeroed in on these numbers and these revisions and made it a political question. kind of accusing people of rigging the numbers to make him look bad, as if the Fed needs like another political issue to deal with. They are making these very complicated decisions on numbers that are now the subject of political scrutiny by President Trump and his allies.
So the Fed has made this decision. How long does it take for the Fed to see how effective a rate cut, a rate decision is?
Yeah, I mean, the one thing that Fed policymakers often will say is that monetary policy works with long and variable lags, right?
It's a famous quote.
A famous quote. And so there's not like a clear-cut answer to that, right? Like, it's not the case that the Fed cuts rates and we start to see, the economy opening up the next day. And in some ways, it's even a bigger question now because the economy has performed in ways that have been so surprising after the pandemic. Like, even with interest rates being in a place that most economists see as like at least somewhat restrictive, we're still seeing consumer spending hold up pretty well. And so it's not an easy question to answer because you just don't know how monetary policy changes are going to filter through the economy and how quickly.
On Wednesday, Fed policymakers projected there will be an additional 25 basis point cut by the end of the year.
The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course.
I think Powell and many of the policymakers don't like to be boxed in. And so I think you can expect them to continue to try to preserve their optionality, right? Even Governor Waller, who has been pretty clear that he wants to see rate cuts, has said, we don't have to be on like a predetermined sequence. We can begin cutting and then kind of see where things go, see how things evolve. And so I would expect Powell and other policymakers to continue to do that, especially given this very complicated backdrop that we've been talking about, both economically and politically. Why would they box themselves in?
This is The Big Take from Bloomberg News. I'm David Gura. To get more from The Big Take and unlimited access to all of Bloomberg.com, subscribe today at Bloomberg.com/podcast offer. If you like this episode, make sure to follow and review The Big Take wherever you listen to podcasts. It helps people find the show. Thanks for listening. We'll be back tomorrow.